So I have finally sold Dixon Technologies. I have sold into strength. The purpose of selling the stock was not because there is something wrong with the stock or the situation has changed. The stock is still in a stage two uptrend. However, I sold into strength because I want to use that profit to finance the risk on my future trades. So this is very common. The best traders in the world sell into strength. You buy a stock, you give it some time, it gives you a decent return in a short period of time. You could sell into strength and then use that profit to finance the risk on your other trades. So this is a perfect example of that. Now, before I get into where I bought and where did I sell, let us first discuss on the day when I actually purchased the stock, what were the ratings or parameters? Why did I buy the stock in the first place? So I bought the stock on this day at the yellow line, okay? And I sold it here on 11th of October. I will tell you why did I buy and why did I sell. Okay, there is sound logic behind these decisions. These are not random guesses. I am not selling a stock based on what I feel about the company. I am selling a stock uh, based on mathematics. I am calculating what my profit is going to be, and that profit helps me determine what my position size should be on my next stock. If the next stock gives me a position trading opportunity where the technical and fundamentals of the company are great, I might take a larger position size because I have already made a profit here. So I want to capitalize on that gain. But we are getting too far ahead. Let us come back to my buying decision. So, first, I had made an attempt to buy the stock on this day. Okay. And I had made a video on this, if I remember correctly. I bought here. It did not go up. The follow through was not there. I lost around 2.5%. There, I cut my loss short. Then it set up another buy point. So I bought here. This time I was successful. So there were two attempts to buy the stock. Now, why did I make two attempts to buy the same stock? Well, the answer is very simple because the base was still intact, the uptrend was still intact, the ratings of the company, the fundamentals of the company are still intact. Uh, there are there's some excellent news coming up about the company regarding new orders, new clients, etc. So everything looks fine from the market perspective. So, but still, sometimes we as professional traders, we have to make a couple of attempts, maybe three attempts to properly get an entry into the stock. And my first attempt failed, so I lost around 2.5%. Second attempt, I was successful. I made around 14.81%. And that gives me a nice gain, which I can use. So coming back to these ratings, let me explain this quickly in a couple of minutes. 83 is the master score. This is a score given by MarketSmith to every stock in the stock market. As long as this number is more than 60, it is very good. So the MarketSmith platform will look at the technicals and fundamentals of the company, and based on that, they will decide the rating. They will compare the technicals and fundamentals of that company with all the other companies in the stock market, and they will come up with a rating. So this is a proprietary number. I don't know what calculations they do, but I do know that this number involves technical as well as fundamental factors. Next is 95. This is earnings strength. So 95 indicates that Dixon Technologies has earnings stability, growth, and consistency, which is better than 95% of all the stocks in the Indian stock market. 85 represents the price trend. So 85 means the 52-week performance of Dixon Technologies is better than 85% of all the stocks in the Indian stock market. Okay. And by the way, these are ratings before I bought the stock, not after I bought the stock. Okay. Just before I bought the stock, this is what I was looking at. Okay. So I was trying to put the odds in my favor. I want the technical and fundamental factors in my favor. Okay. B represents institutional demand. So institutional demand is categorized into five buckets: A, B, C, D, E. So if it is A and B, then there is a decent institutional demand. So here you have a B rating, fantastic. 28 is the industry group rank. As long as that number is less than 40, is considered to be good by MarketSmith. It's a leading stock in a leading industry. Okay, it's a market leader, by the way. This is a electronics contract manufacturer. They have clients like HP, Acer, Asus, Lenovo, the tablets and the laptops. You know, this company manufactures those tablets and laptops, and then companies like Samsung, Lenovo, they put their branding and they sell it in the market. So this is a very key supplier to these big electronics companies. And that reflects in the fundamentals. I mean, this is the earnings growth, latest quarter earnings growth. Okay. So I think this is June quarter. So this is 107% growth in quarterly earnings. So you compare the June quarter of 2024 with the June quarter of 2023 and you look at the growth, this is that number. Okay. So 100% growth. So the earnings have doubled from the same quarter last year. And the sales have also doubled, 100% growth in quarterly sales. 22% represents the return on equity. Return on equity, the minimum we need is 17%. As per William O'Neill's book, How to Make Money in Stock, 17% is a decent number. 3 represents the stage or the base number when I'm buying this stock. So you see this base that I have drawn here. This is base number 3. So when a stock starts an uptrend, it goes through 3 stages: early stage, middle stage, late stage. Early stage consists of base 1 and 2. Middle stage is base 3. Late stage is base 4, base 5. By the time the stock reaches base 4, base 5, it has run up a lot, maybe given a triple digit return from base 2 till base 4 or 5. That's 100% return minimum. Okay. So by the time the stock reaches base 4, base 5, everybody knows about the story, everybody knows about the stock, and people are buying the stock. So they are getting in late. Usually these are retail traders who get in late in the stock. But I am buying somewhere in the middle because this is base number 3. And 4 represents the number of points in the base that I'm looking at. So I tend to draw the base points like this. So let's say if this is the base, this is 0.1, 0.2, 0.3, 0.4, 0.5, and then I would buy. Okay. So in this case, since I bought here, I was looking at these 4 points. That's 0.1, 0.2, 0.3, 0.4. So I want to see contractions. I want to see minimum 4 points in the base. By the way, this is called as failure pivot reset. Let me explain what that is. This is nicely explained in Mark Minervini's first book, Trade Like a Stock Market Wizard. Go to that book, open chapter number 10. In chapter number 10, he explains a concept called as failure pivot reset. So what happens is, this is a pivot point. Okay, this is a buy point because there is price tightening inside the base. So when you buy here on this candle on 23rd August, and if it fails, this represents the failure of this buy point. Okay, it does not represent the failure of the base. If this price comes down and cuts this low, okay, touches this low, then we can say the base has failed. But as long as it remains above this base low, we can only say that the pivot point or the buy point has failed. So I buy here, the buy point fails, it comes down, then it starts to reverse. See, this is a piercing pattern. It goes up, and then you have 2 tight price action days. Okay, very tight closing. So it sets up another buy point here, and that's what I call, what Mark Minervini calls failure pivot reset. So the pivot point or the buy point has been reset here. So here you have another buy point. So on this day, immediately as the market opened and the price started to trade above this yellow line, I put in my order with a 5% position size, and I gave the stock time. I looked at volume coming in. Look at this high volume. See, the volume, average volume is 603,000, but the overall volume that came for the day is more than twice of that. So this is very high volume, good price action day. So this is called as a true breakout. And these are the reasons why I bought the stock. Okay, so we have completed the buying part. Why did I buy the stock? So you have good ratings, you have blue, green, red. So the 50-day moving average is above the 150-day simple moving average, and the 150-day simple is above the 200-day simple moving average. So the stock is in a nice stage 2 uptrend. The stock is showing good relative strength, earning strength, master score. It is also showing good fundamentals. It is not too far below the 52-week high. It is showing institutional demand. So if all these factors are in my favor, it's like I am putting all the odds in my favor. And then based on these technical things that I mentioned, the buy point and the failure of that point, and then again a reset of that point. As long as you understand that price action that is happening, the ratings and all is not the difficult part. The actual entry, this trade was about trade execution. Okay, it was not much about technicals and fundamentals that anybody can check. That's very easy. This was more about execution and patience. Okay. Why patience? I will tell you. So I bought the stock on this day at the yellow line. So 13120. So my purchase price came around 13112 because I was buying in parts. So if I want to buy, let's say, 100 shares of a company, I will never buy 100 when it touches the yellow line. I'll buy 50, then I'll buy 10, then I'll buy 10, then I'll buy another 10, something like that I will do. But I will always try to buy within 1% distance from the yellow line so that there is not much slippage. Okay. I don't want to buy an extended stock. So I buy here. The day is strong. The stock closes 7.39% from the previous day close on very high volume. So now I know that I have made the purchase at the right time. This is why timing is extremely important. If you read Mark Minervini's second book, Think and Trade Like a Champion, the last chapter or second last chapter is 8 keys to super performance. And out of those 8 keys, one of the keys is called timing. Okay. So timing is extremely important. I cannot buy the stock here. I have to wait till the pivot point resets. And then as the stock starts to move up on the lower time frames with high volume, I make my purchase and then I see whether I am getting the follow through. Unless all of these confirmations happen, I am not taking an entry into the stock. It's not worth my time. Okay. So now something happened from 16th September till about 7th of October. So this 20-25 day period was extremely tough for traders because it tested the patience of the traders, especially in India. Because what happened is during this period, China announced some stimulus package, okay, and they artificially propped up the Chinese stock market. The Chinese stock market shot up like 30-35% in this period. Okay. And that was because of the government stimulus package to boost the economy and the boost the stock market. So it was artificially boosted up. So what happened is the foreign money that was lying around in India, the foreigners sold stock in India and took that money and put it in Chinese market. Okay. Otherwise, how would that stock, though that stock market had gone up? So the money moved from India to China. So that put a lot of pressure on the broader Indian stock market. Okay. And that was the cause of this particular painful period. No stocks were moving in this period. However, I began to notice something interesting in the stock market during this period. Stocks which were showing unusual fundamental strength. Okay, so this is like triple digit growth in quarterly sales earnings. Stocks which were showing fundamental strength were falling less. So, for example, if the index or the general market, so for example, in India, you have the Nifty 50 index. So, if the Nifty falls 1%, generally the stocks should fall two times or three times of that 2%, 3%, 4%. Okay, that's normal price action. If the Nifty falls 1% and stocks fall 5 6%, okay, that is not normal. That stock is genuinely weak. It has weak fundamentals or whatever. So in this period, I noticed that Dixon Technologies, one day the market fell down 2%. The index, the general market, 2% is huge. But Dixon fell only 4%. Okay, Dixon should have fallen 6%, 8% on that day because that was a disaster. But Dixon fell down only 4%, so which indicates a sign of strength. Another day, I observed that during this period, on one particular day, I don't remember which day, but on one particular day, the market fell, the index fell 1%. Okay, 1% or 0.87, and the stock also fell 1%. So which is not a sign of weakness. This is actually a sign of strength. People who do not understand how to read price and volume will never get this point. But I am saying that a stock which falls 4% in a single day is actually a sign of strength. A stock which falls 1% in a single day, showing you a red candle, it is actually a sign of strength. How do you know that? Because you have to compare it with the major index in the market. If the index is falling 1%, it is normal for stocks to fall 3%, 4%, even maybe more than that. Okay, stocks which are fundamentally weak will fall even more. But stocks which are fundamentally strong, imagine the index falls 1%, but the stock doesn't move at all. That's a sign of strength. Okay, that is not a sign of weakness or low volume or institutional selling. Okay, so that gave me a tip off, that gave me a hint that I should not sell the stock during this period. Now, I had made a video when this candle closed. I remember I showed you that there was a 7% profit. Okay. That 7% profit began to erode very fast. It went from 7% profit to 2 3% profit by the time the stock came here. But I had conviction in the stock because I had numbers on the table. Okay. I said, okay, by the time this green candle came, I was not seeing any strength at all in the stock. So by the time this green candle came, my stop loss I had already moved to the yellow line. So I said to myself, this much fall is enough, and this much is fall I can tolerate because I had already bought the stock on 16th of September. Now we are talking 4th of October. So it's almost 3 weeks I am holding on to the stock and I'm just looking at 2% return in my account. So that is not a good sign. So if a stock is giving you like 2% return after holding it for 3 weeks, that is not a sign of strength in terms of absolute strength. Relatively, it's doing very well, but absolute strength wise, it is just sucking away my time. That is why I had to move my stop loss up. But eventually, my patience paid off. I did not sell because the price still remained above the blue line, which is the 50-day simple moving average. And eventually, there came a day when the stock shot up 7.47%. On that day, I had a sigh of relief because my patience paid off, my conviction in the stock paid off. Then it continued to rise. Now comes the decision of selling. Now, selling is where trading becomes more of an art than science. Okay. So selling, I was closely observing the price action in the stock compared to the market as well. So 1, 2, 3, 4. On this day, I sold the stock to book a 14.81%. So that's the price. So I sold at 1508.6 something, and my buy price was 13112. That's roughly around 14.81% return. I checked in my broking account to be precise. Okay. So I sold on 11th of October and I bought on 16th of September. So you can see I have been holding the stock for almost a month. In a month, if I'm getting double digit return, I'm happy with that. The only thing I should have done here is I could have entered with a larger position size. Imagine if I put 25% of my account here and it goes up 14%, we are talking about a return of 3-4% on a portfolio level. That is huge. Okay. So trading is more a game of position size and risk management than it is a game of reading charts. See, chart reading ability you will learn eventually. Ratings, rankings, how to read them, you will learn eventually. Where you will struggle is position size and risk management. Okay. I have students where they start with a position size of 1%. They are so afraid to buy the stock that they start with a position size of 1%. But then I have to teach them to gradually increase their position size. Now, I personally took a 5% position size because the overall market, I see a lot of weakness in the overall market. Okay. Plus, there is a falling window on the general market index. So if the index is showing a falling window, that's not a good sign for the overall market. So I have been very cautious, and naturally, if you have been watching my videos, I am naturally a conservative personality. I don't like to take too much risk. Okay. And even if I take risk, it is on the basis of the previous realized gains that I have booked. I will not risk my capital. I will risk the capital that the market has given me. So I sold here, and you see it continues to go up. Now, why did I sell here? Why not here? So as you can see, 1, 2, 3, 4. So 4 days of consecutive up closing, but 4 days of consecutively lower volume. So the price is going up and the volume is falling. That is called as price volume divergence. So the rally, this rally here is a weak rally, because naturally I want to see, when after this candle I want to see two, three more candles with equal or more volume. That shows a sign of institutional buying, because institutions will not buy the stock in a single day. They will buy the stock over a period of 3, 4 days or 1 week. But that did not happen here. Price is going up, volume is going down. What does that mean? It means the buying, there is not enough buying power. The force is not there. So if the force is not there, what do you think should happen to the price? The price could collapse. There, after this candle, there could easily have been a big red candle with a 5% crash, right? Something like this or something like this. This is 5.68%. Not a big fall as when you look at the chart, but when you look at your PNL, that's a big uh, erosion of your unrealized gains. So I decided to book my profits. So that now has become a realized gain. Now on the next stock that I buy, I could take 10, 15% position size, maybe more, depending on my risk appetite. And then let's see how it goes from there. But selling into strength is extremely important. I have not looked at moving averages here. I could easily say that I will hold on to the stock as long as it remains above the purple line. The purple line is nothing but the 21-day exponential moving average. The blue, green, and red are the simple moving averages. The purple is the exponential moving average. Okay. So I could easily say that as long as the stock remains above the purple line, I could hold on to the stock. That is one argument. That is another way of trading the stock. You could choose to do that, but I personally, I want to take money off the table and use that money to get into another uh, trade. So that's my complete analysis of Dixon. It's been a long story. The story started for me on 23rd of August, and I'm now making a video. Today is what? October. So for August, September, October. So I continue to say that every trade is a story, and you should be able to narrate that story properly. I have been discussing this stock for around 15, 20 minutes. I have not checked the time. But if you can discuss a particular stock for 15, 20 minutes in one go, okay, that means you're really involved. I mean, you know what you're doing. So I want you people to reach a stage where you can have a detailed discussion about a stock. This is not some guesswork or some gambling or something. There are certain technical things that I have looked at on this chart, which has allowed me to take a proper entry and a proper exit. So I bought here because there was a failure pivot reset, and I sold here because there is a divergence of price and volume. As simple as that. Okay. So the market is telling me when I should buy and when I should sell. I don't force myself to buy a stock. The market tells me when to buy, when to sell. Now, selling, as I said, is more of an art. So that is very subjective. You could keep the stock as long as it remains above the purple line. You could keep the stock as long as it remains above the blue line. Okay. Your choice, your risk appetite. Okay. Depending on how much risk you can tolerate, you can manage your positions. But from my experience and plus the readings that I have done, I can tell you the best traders in the world, they sell into strength. Or you could do some partial selling and keep some shares to capture the gain if there is still more upside left in the stock. Now, my goal here is eventually the stock will start to form another base. Okay. Just like it did after this base, it formed a failure pivot reset. When it forms the next base, I will try to get in again. But remember, that is going to be base number 4. So that is going to be late stage. So a lot of people are going to jump onto the stock. So I might take a quick double digit gain on that position as I did here. So a quick double digit return in less than a month or so, I would be happy with that. So that is how I would trade a fundamentally strong stock. There are cases where I would remain invested in a stock for a very long period of time. But these days, I don't do that. I would like to move my money from one stock to other stocks so that you can compound your portfolio. So that's my whole discussion on Dixon. So if you want to discuss more about this, or if you have questions, just write to me in the comment section, just email me or whatever. Let's have a discussion. I hope you liked the story. So every trade is a story which you never forget because you are involved in what you are doing. You are a professional stock trader. Okay. Thank you so much.